Common rent roll formats and fields. So I'm going to share a screen with I'm going to start with a T12. A T12 stands for a trailing 12. So that is going to be the most recent 12 months of the income and expenses of a multifamily property. And here's one right here. This is all fictitious numbers. So just as an example, here we go. So as you can see, there's 12 months, right? These are actual numbers from a property that have been accrued over these months. And this is what every property will do. They will need to do to show their expenses and income, and they're therefore showing their NOI, which is, here it is, net operating income, right? And here's the total amount of the past 12 months. So we're just going to go over some most common things that you will find in a T12. Are you able to see this? It's a little too far. Here we go. So I'm just going to hone in on one section here because it's all the same, right? It's just on a 12-month basis. So you, of course, have your gross potential rent. That is your units and how much income you have with all of your units, right? So this is what we're assuming that we are going to get per month from all the units. And then there's loss or gain to lease, right? Which is always most of the time going to be a negative number. And then there's going to be vacancy. There's always going to be a vacancy component. Most of the time that not 100% of the units are going to be rented out. And then there's concessions, right? So sometimes they offer percentages off of your rent or a free month's rent, just to get the stabilization to be consistent. And there is bad debt, which is when some people aren't able to pay, and sometimes they'll pay in a later month. That's why this is positive in some of the months. Some other income. So other than the fact that people are paying rent, they're paying other things. So sometimes they pay for pets, they pay for parking or eviction, or there's so many other income possibilities. It just depends on the specific property, or it usually depends on the size. So the larger the size is, usually there's more other income. So continuing on, we're going to get into our expenses. So every T12, of course, has its expenses. Majority of the expenses come from the property taxes or the payroll. So here you see you have payroll. Of course, the larger the property, the more payroll you have to pay. So here at this fake property, they have a manager, assistant manager, a leasing officer or assistant, administrative bonuses paid. So all these things are a factor, and each month they have 24,000 this month, 26,000 this month, and of course that builds up. And then moving in, then you have general and administrative expenses, right? So that's just basic necessities in order to run a business, such as these things right here: telephone answering, training, miscellaneous, all that kind of good stuff. Then you have the management fee. So you either have your own management team or you have a third-party management company. Of course, you need to have, you're going to be paying that company. In our case, we use a third party, so they take 2.5%, and that would be, of course, an expense paid. Okay, continuing on, we have marketing expenses. That's kind of self-explanatory as well, right? So you need to advertise, whether that's Facebook Marketplace, that's putting up signs, whatever it may be, call center services. Okay, then there's contract services. So this is going to be going into your pest control and your landscaping and cleaning the pool, your security, your alarms, all that stuff. That kind of is bundled up here in your contract services. That, of course, is another expense. Here we go. Here's another one: repair and maintenance, right? Things are going to break, of course. People are using them constantly, whether that's, there is a pipe burst or your oven doesn't work. These are, of course, expenses that we're going to replace at no charge, but it is an expense for us, right? And then there's turnover. So when a person's lease is over, of course, we're going to go in, we're going to paint that unit, we're going to clean it up. So it's a brand new, perfect apartment for that next person coming in. That's called a turnover expense. Usually a large expense you'd find is carpet. Carpet is definitely uh, treated not the best. So you're going to have a lot of spills and cleaning. So that's constantly being replaced. You can kind of see that here. And of course, painting as well is another large one. So another thing to note is that there's expenses here that are significantly larger than others. So look at this here, repair and maintenance. Plumbing is always going to be a high expense. So when you're looking at these, you know what to expect, right? If something is out of the ordinary, you're going to find it right here. So this is interesting. Why did we get a credit here for 825 from here? So there's a story painted in every single T12 presented. It's just a matter of, can you figure out why, and does this make sense? So this is what we're looking at on a deal-to-deal basis in order to understand what is going on internally with these tenants and why some things are higher or lower. And this gives us a great idea of what we will expect when we come into the property, right? If we see that payroll, let's go back up here. If we see that, say this is a brand new deal, this is a 2021 build, and they are trying to stabilize the deal, meaning getting the occupancy below, equal or above 90%. We're going to see this leasing person have it. This leasing is going to have an extremely high number. Maybe it's 5,000, right? And then it drops off after 4 months. You can tell that they got rid of a leasing person because they were they were being more and more stabilized, so they didn't need that extra manpower. So you can tell a lot from a T12 perspective. I have some. If you guys have any questions, please feel free to write in the chat box. I will do my best to get to all those. I see some things are coming in here. Okay, great. So we got up to turnover. Now utilities. This is another large expense, right? Of course, you're going to have power, gas, electric, all that stuff is going to be added up, and that is, of course, on the owner. And a lot of times, a lot of properties will do a chargeback system where sometimes the tenants will pay, but on larger units, they usually do not. So water and sewer. So that's usually, depending on the area, the largest expense for utilities. I know we do a lot of business in Charleston, South Carolina, and water is very expensive, right? So that's just something you need to keep an eye on. So for instance, right here in this month, why was this a lot more than this month right here? And why was this month a lot less than this month, right? So you need to be asking those questions, asking the current property manager and or owner as why that is, right? And then, of course, we have insurance and our taxes. Taxes, you can find, taxes are a little bit difficult, of course, because it's on a county basis. It's all public though, right? So you're able to find this. You can see the accuracy of this number by just going and doing a quick Google search. And that's what we do on every property. That's a necessary thing that you need to do. Okay, and then insurance, of course, if you're closer to the coast, it's going to be more expensive. If you're in the southeast, let's call it Florida, where there's many hurricanes, that number may rise. And we usually underwrite on a per door basis, and we get multiple people to come in and give us numbers, but that's besides the point. Okay, and then after all that, right, the T12 is going to compute this NOI, net operating income. So that is your income minus your expenses, not including debt services, right? So you can see this property, this fictitious property, in a 12-month period has a $1.9 million NOI, right? That's not bad for a larger deal. Okay, I'm gonna move on into, oh, I see a great question. Let me get to that. So it says, where is your CapEx? I lost it. Someone asked, where is your CapEx? Your CapEx expenses? They are not capital expenditures. They are usually not included in the T12. Sometimes they will be, but that number is not included in the NOI. Never. The CapEx is never included in the NOI. Okay. Let's move forward. I'm going to share now a rent roll. Are you guys able to see this rent roll? If you can someone just say yes? Okay, I think perfect. Thank you. Okay. So here is a rent roll of this is all fake, fictitious stuff here. Let me get my head out of the way so I can see my screen. So a rent roll is just a basically a roll of everyone that has signed a lease or is a future tenant in every single unit, right? So in this property, let me go to the bottom here because it has the summary. Or it does not have the summary. Here it is. So here is the summary, right? There are 224 occupied units with a total of 239 units. So the rent roll will show you your occupancy or vacancy, whatever other way you want to look at it. It'll show you your unit type, how much people are paying per unit, and on average, what we're marketing these units to be and what they're actually being charged. So you can see that loss to lease. You can see how much pet rent overall you're getting of income. It shows you all these percentages on a per unit basis, right? So if you want to go in and check at one person, right? And you want to see, what is this person paying for B11? They're scheduled to, let me go up here so you can see the top. So this person is renting a D2 unit. So it's a 2x2, 2 bathrooms, 2 bedrooms. And the marketing rent, so we posted, or this property posted this rent for $2,045. They got a great deal on this unit. They are paying $1,640 for this, right? And then there's additional other income, right? So there's parking and then there's an amenity fee with a total of $1,755. That's great on their part, right? They were able to knock down, maybe even get some concessions. So there's always a story to be told here as well in the rent roll. And a lot of times, so it'll have the move-in date, the lease start, the lease end. This will paint the picture of who is renting from you, how much they're renting it for, what room they're renting in, how long their lease is signed for, and how much they may owe. Of course, so this will be bad debt if it's negative, right? And then expected move out. So this helps us kind of with our demographic study. We'll know, we'll get a lot more information from this. This will help us know how much occupancy, how well the property is performing on an occupancy perspective. And then what else? It will show us the loss to lease, which is a large factor that will also go in the T12. I have some more questions here. Let me see if I can scroll slowly. Okay. They were pertaining to the T12. I can get back to those in a little bit. Okay. Furthermore, let me go to the bottom again where it has all the summation of everything. So this is a great way to also see your unit mix. So your unit mix is what your property is made up of unit-wise. So that could be square footage, that could be a unit type. Usually unit type, so let's call it CA. This will be, well, there's only one unit. All these A1 ones will have the same square footage. So they'll all be marketed roughly at this number. And then the scheduled rent, this will probably be an average of all of the A1 ones. So this is just a great way of seeing your property as a whole and seeing what is being rented for a premium, what is lacking. For instance, let's see if we can get a good example. These people might have a large loss to lease, as you can tell. And a lot of times you might have a large loss to lease because there may be a lot of other properties in the neighborhood that are going for a lot less rent. This may be a stabilization, meaning that it's a newer deal and they're just trying to lease up as many units as possible. And after that 12-month period, they may try to increase rents. Let's go back to this page here and let's go over some of these check marks here. So cash accounting or accrued accounting for a T12. Let me explain that. So this is an accrual, meaning that the gross potential rent is a projection. This is a projection of what the property expects to get on a monthly basis. That said, this number can be incorrect. It cannot be as accurate as a cash T12. You would prefer to get a cash, let's see what a cash accounting T12 is more accurate because it is exact amounts of how much this property has made compared to an accrued, which is a projection, right? So if you ever have an opportunity to get a cash accounting T12, that is of course preferred over an accrued T12, which is this one right here. Most of the time when it comes to multifamily, they're going to be accrual. So they are going to be projected of gross potential rent. Okay. Furthermore, how do we use the reports for underwriting purposes? That's a great question to go over. So on a deal-to-deal basis, we actually use a software to do this, so it mitigates, let me zoom in here, sorry about that. It mitigates human error, but of course, you will have a model that you need to input financials in order to compute returns. So we will use T12 and rent roll numbers to come up with these returns. In order to do that, you need to pull the income and expense numbers, and those total numbers will be on a yearly basis. The best way to do this is to go in and take the totals. So let's start with the GPR. You will have a section in your underwriting model that will have GPR on a T12 basis. You will go in and you will type this number right here. And then you will have a loss to lease section and you will type this number in. And then furthermore, you will just continue that process all the way down with all of these numbers so it can be as accurate as possible, right? And then that's the best way to pull out the information. Now, when it comes to inputting your unit mix, that will be pulled from your rent roll right here. So at the bottom of every rent roll, on larger deals especially, there will be a summary of your unit type and the market pricing, and a lot of times, it's not here, but a lot of times it will have the square footage as well. And this is the best place to add in your unit mix into your underwriting. Okay. Let's see. Let's answer some questions here. What is the underwriting software that you use? We use a software called RedIQ. I believe they are owned by Berkadia, the brokerage, and they have an add-in to, let me show you here. If you can see this add-in to Excel, they have an add-in component into your Excel, and it'll pull these numbers from a T12 basis and put it into your proprietary model. So that service, of course, costs a fee, but just so you know, that's how we do it. So there's no human error. Let me see. Other questions here. Does the delta between market rent and actual rent tell you there is upside to raise rents, or are concessions needed to fill the units at the lower actual levels? Well, that depends on it depends on on a per property basis, right? So it really just depends on that. Repeat software. The software is RedIQ. Does RedIQ pull data from a PDF into an Excel sheet? Yes, it can pull both PDF and Excel. It doesn't really matter. They have a team, a back-end team that can work with any type of, whether that's a PDF or any other file type. I'm trying to keep up with your questions here. Sorry about that. Will spreadsheets be made available? I am not sure about that. That is something that I will ask Melissa and then get back to you. If so, we'll make sure that everyone has access to these. How many underwrites do you do for a deal? I know some underwrite about 10, 15 times. That's a great question. It depends, of course, but I think on average, we are doing about 15 to 20 underwrites per deal, just to change small things. We're constantly tweaking our model on a per market basis. But I think 15 to 20 times, whether it's just changing something really small and updating it. But yes, once you like a deal and you get into the nitty gritty, you definitely change things constantly. So they are to your liking. How does one arrive at an accurate expected annual capital expense, non-operating income, and expenses? How does one arrive at an accurate expected annual capital expenditure? Well, we use reserves as a capital expenditure. We use $250 per door. That just depends on what kind of property that you're investing in, right? If it's an older property, there's probably going to be more expenses on the repair and maintenance side, and maybe you need more reserves for capital expenditures, whatever it may be. We kind of have a general idea of how much things cost expense-wise per market for the type of deal that we look at, right? So that is more of an experience thing. The more you underwrite, the more you understand what things should cost, especially if you're using the same property management team, which we happen to do. We use the same team. And if you're using the same team and underwriting in the same markets with a similar deal, you're able to kind of understand what number is going to make sense in order to best underwrite for each deal. What do you see as your average expense percentage to the gross revenue number? That is a great point. That's kind of hard to show with these numbers here, but it's usually like a 30% maybe a little bit more. That's a rough number, of course. Maybe 30 to 40%, but that's just kind of hard to show with this here now. Um, let's see if there's other questions. I lost the chat box here. Sorry, guys. Do you usually see the same format for a T12 report, or do you need to make adjustments to plug the numbers into your financial model? That's a great question. It really just okay. It depends on the size that you're looking at. If you're looking at large institutional properties, let's call it 200 plus units, a lot of the T12s are very similar, right? They use specific softwares, let's call it Yardy or XYZ, it doesn't matter, but they have very, very similar setups to this, where our software, RedIQ, actually recognizes which software it uses, and it has no problem reading it. And so there's really not much adjusting, but after you do multiple underwrites, you will notice that there is a trend into how they name things. You see how they have numbers here. There's always going to be numbers. That's just how, that comes from their system. So of course they have a software that's doing all this. This is not a person typing in all of these numbers. But yes, it's very, very similar every time. And rent rolls, you'll see that they kind of change a little bit more than T12s, which can be annoying, but you just get used to it. They're similar concepts, right? You have a unit, you have a person subscribed to that unit, and then you have their charges and all the information. So it's very similar. It's easy to adjust from different platforms that they're coming from. But that's a great question. I'm seeing questions come in both boxes here. Let me cross over to the other one here. Okay. Sorry about that. A question here is, do you use the same property management team in both the Carolinas and in Florida properties? Yes, we use the same team. They're called FCA properties. They are our property management on everypassiveinvesting.com. And yes, they do. They're in the Carolinas and in Florida. Okay. Anything else? Any more questions here? When forming your offer, do you use projected expenses or just what they have? That's a good question. So we'll have the T12 expenses, and then we'll have a pro forma expense, right? What future expenses we think we will encounter. And a lot of that is, of course, based off the T12, right? So if you're in the Charleston market, we know that water is going to be higher. So yes, we'll have both of that when forming an offer. I hope that answers your question. Let's see here. 4626 line COVID. Here we go. What changes are made in underwriting for COVID? Great question. So a lot of times you'll see expenses that come from COVID-19. I don't know what exactly. So utilities for COVID-19. Sometimes they have weird names for these, but a lot of times you'll see expenses for COVID-19, which will be like cleaning expenses. If someone needs to quarantine, they'll help them set up, and that property will encounter expenses. I don't see how they would get any revenue from COVID-19. It looks like this is adjusted throughout. But yeah, a lot of times that's kind of dying off. But in the peak months, you would see a lot of line items that were for COVID-19 expenses, and that's kind of the new normal, unfortunately. Okay. I'm going to take a few more questions here. I'm just searching for them. If you have any more questions, please feel free to type them in either chat box. How do you calculate P&I for debt? I usually calculate interest only, but do not know. I don't know what you're referring to. If you might be more specific there. I see a lot of questions coming in pertaining to this recording. I think Melissa is trying to respond to those, but the recording will be available. I believe it'll be emailed out. So yeah, you'll have this recording, so you can go over it. You can view these sheets, I believe, and yep. What would be a high turnover per unit, and why the CapEx is never added to the NOI? That's a great question. So the NOI is net operating income, right? The capital expenditure is never included. It's a separate expense, right? It's not an annual expense or a monthly expense, right? It's a one-time expense that the property manager or owner wants to add value to the property, right? So say they redo the clubhouse, they're not redoing that clubhouse every single month. So that's not a consistent expense that is going to be in your T12, your trailing 12. So most of the time, if there is a capital expenditure, it will be located at the bottom. You will see all that, what they've done. This property obviously has not done any capital expenditures, but it will be here. You'll be able to see what they have done, how much it has cost them, but it'll just not affect your net operating income, right? Because this is your monthly income minus your monthly expenses, things that are on a monthly, or annually charge. So that is why it's not included. Okay. Are the income lines annualized for the last 3 months when underwriting? So, okay, that kind of, I'm not sure if I fully understand that question, but I want that can lead into something great. So a lot of times when it's a newer company, or sorry, newer asset, there will only be 1, 2, maybe even 3 months of income and expenses. So that would be a T1, T2, T3. And sometimes you have to annualize that, right? So you're underwriting and valuing and looking at numbers on a yearly basis. That's always the case. So in order to do that, you will just have to multiply it out. It'll of course be less accurate, but that is just how, we use the numbers that we have in order to compute possible, numbers, if that makes sense. So let me give an example. So say this is a new property and they have only 1 month of income and expenses. So let's hide this. So in order to annualize this, you would have to take the GPR and multiply it by 12, right? And then, of course, this is a number. And then you would just drag and pull. So you have all this. Now you wouldn't take, for instance, property tax or insurance on a T1 basis, because those things you can find online. But look at this. So even after hiding these, we know that on a T1 basis, this is our gross potential rent. This is our loss to lease. These are actual numbers, but we're just pretending that we only have 1 month. So when it's a newer build, or there's a lack of information, this is just one way of using that. And yeah, hope that makes sense. I heard the income is 3 months annualized and the expenses kept at T12. No, I think everything's monthly, on a monthly basis. Yep. Okay, I'm going to answer a few more questions here, and then I think we're going to wrap it up. If the property only gives you 1 month for a rent roll, is that a red flag? If the property has been into an existence for quite some time, yes, that's a red flag. You want to see a rent roll, or is that a rent roll or a T12? A rent roll is usually as a specific date, right? So you get a rent roll as of September 14th, 2021. That is what today's rent roll looks like. You get a screenshot of what if the units are filled, if they're not filled. It's not on a yearly or monthly basis. The T12, however, if you're given only, let's call it 3 months of financials and the property was built in 2005, yes, that's absolutely a red flag. You need to have all those expenses, income, all those numbers. You can even ask them for prior years if it's an older um, building. And I actually recommend that you do that. You should analyze what 2012 numbers look like compared to 2021. Not 2012, excuse me, 2020 to 2021. So that's just another great way to, and they should have that on larger, especially larger properties. When you get into the mom and pop, it may be different. It may be harder to read through these, and maybe sometimes they have less numbers and things of that nature. But yes, that could be a red flag. That just means that they are not paying attention to their numbers. They don't have a system that's recording all their numbers, and that's actually a big problem. Okay, I think I'm going to wrap it up there. We're running out of time here. I want to thank everyone for coming out. I very much appreciate it. Danny, sorry that he couldn't be here. I hope that I covered for him okay. It was great meeting you all. And if you have any questions, please feel free to email me. My email is here. It's chris@passiveinvesting.com. All of our emails as a team should be on passiveinvesting.com's website. So if you have any questions, please feel free to reach out. And I thank you all for joining.